Oi, Morgan, look at the state of your screen, mate. You got more lines on there than the London Underground map. Are you trying to summon a demon or just giving yourself a headache?
Nah, bruv, I'm connecting the dots. It's called Intermarket analysis.
Right.
Maybe if you looked at more than just the 5-minute Bitcoin chart, you'd know what I'm on about. This is how you actually figure out where the market's going next.
Intermarket analysis. Sounds dead peak. Like something you'd find in a CMT textbook.
Yeah.
Go on then, professor. Break it down for the rest of us who just want to make a bit of cash without getting a degree.
All right, listen up. It's bare simple, really.
Okay.
Think of all the markets as a massive, dysfunctional family at a Christmas dinner. You've got stocks. That's the popular, emotional kid who's either buzzing or having a complete meltdown.
Yeah, I know a few traders like that.
Then you've got bonds. That's the old granddad in the corner, the smart money. He doesn't say much. But when he starts moving towards the door, you know something's up. Then you got commodities like oil and gold. They're the loud uncle who's had a few too many and is shouting about how the world's ending.
And the dollar?
The dollar is the dad trying to keep a lid on everything.
Right.
The point is, you can't just listen to the emotional kid, stocks. You have to watch what the granddad, bonds, is doing because he often knows what's coming first. They're all related.
Okay, I'm with you. It's a family. So what are the family rules? How do we know who's about to kick off?
Well, this is the juicy part because the rules change.
Ah.
John Murphy, the don of this stuff, laid it all out. Pre-1998, in a world where everyone was worried about inflation, stocks and bonds were mates. Bonds prices went up, interest rates went down, and stocks got gassed. Simple.
Hold up. That's not how it works now, is it?
No.
I see bonds rally like the TOT, the 20-year bond ETF, and a NASDAQ absolutely shits the bed on the same day. What's that about?
Exactly, mate. That's the whole point. The game flipped. After the Asian crisis, we entered a new world, a low-growth or deflationary world.
Wow.
Emphatic. Now, stocks and bonds are enemies. They have an inverse relationship.
Translate that.
When bond prices rip higher, it means big money is terrified of a recession or some crisis.
Okay.
They're dumping risky stocks and running for the safety of government bonds. So a big green candle on the bond chart is a massive red flag for your stock portfolio. If you don't know that rule, you're trading blind. You're getting mugged off.
So, a simple rule. Bonds up, stocks down. What other family feuds do I need to know about?
The other classic is the US dollar versus commodities.
Right.
Especially gold. They're proper rivals. Generally, when the dollar index, the DXY, gets stronger, gold gets weaker.
Why though?
Because most commodities are priced in dollars.
Okay.
If the dollar gets stronger, you need fewer of them to buy the same ounce of gold. So the price of gold in dollars has to come down. It's basic math, but you'd be amazed how many people are trying to long gold while the DXY is going parabolic.
Okay.
Don't be that guy.
Don't be a melt. Got it. All right. Theory's cool, but this is the Big Short Club. We're about practicals.
For sure.
Give me a concrete setup, Morgan. No fluff.
Easy. Here's a simple one you can go and back test yourself.
Yeah?
It's called the equity bond crossover. You look at the 10-year Treasury rate, not the price, the yield. When that rate crosses below its 25-day moving average, it's a warning shot.
Meaning what?
It means yields are falling, which is the same as bond prices rising.
Okay.
The smart money is getting scared. That's your signal to get defensive on stocks. Maybe take profits on your longs, tighten your stops, or even look for shorts. Conversely, when the rate crosses back above the moving average, the pressure is off. It's a potential green light for stocks.
So basically, if yields are tanking, don't be the hero trying to catch a falling knife in the NASDAQ. That actually makes a lot of sense.
Yeah.
It's like a weather forecast for risk.
That's exactly what it is, and it gets deeper.
Oh, yeah?
This helps you with sector rotation. Think about it. If yields are rising because the economy's booming, what stocks are going to fly? Banks, because they make more money on loans. Industrials, because people are building stuff. Energy, the risk-on names.
And if yields are collapsing?
Everyone's bricking it. They're not buying new cars. They're buying bog roll and beans. So you look at consumer staples, the stuff people have to buy no matter what, and utilities, because everyone still needs to turn the lights on. You rotate from the high flyers to the boring but safe stuff.
Here's a pro tip for you lot listening then, a way to see this live. Go on TradingView, and instead of looking at two separate charts, just type in a ratio.
Yeah.
Try XLE/XLU. That's the energy ETF divided by the utilities ETF. If that chart is trending up, it means energy is beating the safe stuff. The market is in risk-on mode. If it's dumping, risk-off is in control. It's a dead simple vibe check for the entire market.
See? He learns. That ratio is pure intermarket analysis.
I'm trying.
You're comparing two different parts of the family to see who has the upper hand. Another great one is copper versus gold. Copper is for building, it's pro-growth. Gold is for fear. The copper versus gold ratio is one of the best economic indicators out there.
All right. My head's starting to hurt from all this alpha. Let's wrap it up.
Okay, yeah.
We've covered a lot of ground from dysfunctional market families to actual usable setups.
It's a game changer once you get it.
Yeah?
You stop looking at charts in isolation and start seeing the whole board.
For sure. Look, if you lot want to keep this conversation going, ask Morgan his nerdy questions, or just come and have a laugh with us, we've got a chat group. The link's down below. Hop in and have a laugh with us.
Do it.
It's where the real action is.
Yeah, come join us. But before you go, we want to leave you with a question to properly chew on.
Okay.
We've talked about all these rules and relationships between the markets.
Okay.
So here's a question we'd like you to think about.
Looking at the market right now, what is the one intermarket relationship that you think is broken or isn't working as it should be? And why? Is it a warning sign of something big to come, or is it just the new normal in this mad world? Have a think on that. Drop your answers in the comments or in the chat group. Catch you in the next one.